Happy Thursday out there, folks. It's Darius Dale here to present our macro minute for Thursday, May 12th, 2022. Starting with markets this morning, we have stocks down, commodities down, crypto down, dollar up, global bond yields down. Markets still pricing in deflation as they have been all week. Shifting gears to our market moving headlines, this is something that I think will start to get the Fed's attention if you go back to what we experienced in Q4 of 18 when the global credit cycle really dried up. You had 7 high-grade U.S. companies pulled bond issuance after credit risk spiked and inflation came in higher than expected yesterday. You have volume for the week to date is around about 10 billion versus projections of about 35 billion. So a pretty sizable reduction versus expectations in terms of IG credit issuance. That's a big deal. Just 27.9 billion of IG debt has been sold, has been issued through May. Even though we've got a forecast of about 135 billion. So we're already starting to see the credit cycle dry up. We're seeing the rise in the cost of capital that we discussed in our macro scouting report, and not just in corporate borrowing costs, but also mortgage rates and real yields broadly. Those 3 sigma rises in borrowing costs across the economy are going to have adverse impacts on the growth cycle. They're going to have adverse impacts on the profit cycle. And no, we have not seen anything yet in terms of realizing that in the data. This is why markets remain in a very precarious spot. We are at the spot of the cycle where growth is still very robust, but slowing, and it's going to slow a lot faster in the coming quarters. And this is something that we want everyone to be attuned to in terms of trying to buy the dip, quote unquote. Shifting gears, obviously, crypto is the main story this week. We actually dipped below 25,500 at one point overnight, although we rallied back up to somewhere around 27,000, 28,000 as of now. You have other coins posting double-digit percentage slumps. We talked about this earlier in the week. No matter how much something's down, it can always go down another 20, 30, 40, 50%. That's just the percentage change math in terms of suffering drawdowns. You had the sell-off in crypto wipe out more than $200 billion in 24 hours, according to Coin Market Cap. Tether, they're out on Twitter trying to reassure investors, saying they redeemed over 300 million in tokens in the last 24 hours without, quote unquote, a sweat drop. If they haven't had a sweat drop, guess what? They're probably going to at some point in this cycle, because cycles do not get resolved with everyone saying everything is fine. They get resolved when people are panicking. Big movers, Ethereum obviously continued to show weakness, down 4% this morning to down 34% month over month. My God, that was a great sale a month ago. 10-year TIPS yield minus 8 basis points to 27 basis points to up, down 8 basis points this morning, still up 27 basis points month over month. Again, as I talked about, that real yield shock, the real cost of borrowing shock that we're experiencing in the economy is going to come home to roost in terms of the earnings cycle and the growth cycle. And then we're seeing that growth slowdown, the anticipated growth slowdown, really reverberate throughout commodity markets. As I talked about, we've refrained from being long industrial metals this year in terms of our commodity allocation, and that was a fantastic call. We're seeing another 2% decline in the Bloomberg Industrial Metals Index this morning to down 15% month over month as the world really starts to reassess and reallocate probability, reassess the probability distribution associated with growth. One thing I'd call out, shifting gears to our charts this year, I put together the slide for everyone this morning. I know there's a lot of pain out there. We want to be here. We want to help. This is definitely not the time to say, I told you so. This is definitely not the time to say, look at me, I nailed it. I know a lot of firms out there who do what I do for a living are going to be in your face in the today or in the coming days about how much they nailed it and how much they got this shit right. This is not the time for that. This is a time to help people and make sure that we're guiding you and helping you survive this bear market together, because we're all in this together. And this is the spirit and mantra of 42 Macro. So we appreciate you tuning in. But getting back to this slide here, I put this slide together to remind everyone, every investment decision you make or do not make, because those are decisions too, is a choice. It is a choice. And so we want to help you make good choices versus bad choices, particularly in these very inopportune times in the cycle. So it's a good choice to have an active asset allocation, to make timely portfolio construction pivots. It's a bad choice. I got a lot of this last year. Well, is your portfolio beating the SPY or is it beating a 60-40? Well, guess what? It is destroying both of those this year. And that's, again, it's not to say I told you so. It's to say that if you understand where you are in the cycle enough to be able to do these two things, you don't have to worry about this nonsense, which is just a highly correlated expression of the Fed's balance sheet. Good choice, dynamic dollar cost averaging with respect to where we are in the growth cycle, the inflation cycle, the liquidity cycle. Those are the 3 big things you need to get right from a macro risk management perspective. The bad choice would be blind dollar cost averaging. Well, I don't give a damn where I am in the cycle. I'm just going to take X percentage of my paycheck and buy Bitcoin or Ethereum and every month, every week, every month and do that. That is the wrong thing to do. There are better times to buy and there are better times to slow the pace of accumulation to the extent you are a DCA type person, which I know a lot of you are in the crypto space. So again, we're not saying stop DCAing. It's just you need to understand this to understand how much you should DCA, what the frequency of those purchases are, what the size of those purchases are. I think everyone needs to get one of these in a notebook and start to really think twice about and think more deeply about those kinds of decisions that they're making. And then lastly, good choice. Risk manage the evolving distribution of probable outcomes, as opposed to the bad choice would be risk managing your P&L. What I mean by risk managing your P&L is saying, hey, I'm down 40 to 50% in this. I don't want to be down anymore. So I got to trim this. Or I'm down 60, 70% of this, or I'm already down 67%. So I don't want to sell it. I'm going to write it out. Do not make investment decisions based on your P&L, your profit and loss. Make investment decisions according to the evolving distribution of probable outcomes. That is how you put yourself in the best position to take advantage of the next play. This puts you in the best position to take advantage of the last play, which is obviously you don't want to be driving the car looking at the rearview mirror. Getting to one final point I want to make before we get into our VAMs and probable ranges. Just a reminder, you are here. The blue line in this chart shows the G5 central bank balance sheet in dollar terms. That's the Fed, the ECB, the Bank of England, DOJ, and the PBOC out of China. We're around 31 trillion, coming off an all-time high. Obviously, we're having a big impact on global equity market capitalization. That's the red line there. It's been one big trade. So passive investment is not a passive investment. It's an active bet that the blue line is going to continue higher. And as we know, with Europe struggling with inflation, with England, Bank of England struggling with inflation, obviously the Fed struggling with inflation, and China struggling with lockdowns, this chart is moving in the wrong direction. And it's likely to continue moving in the wrong direction, at least over the medium term, until we get to a place in the inflation cycle or the growth cycle to force a real inflection in the liquidity cycle, particularly in the Fed. And we outlined, obviously, 20 slides or those. So in yesterday's, on Tuesday's macro scouting report, to try to help you understand when and where and how that pivot is likely to come. So go check that out. I think that's probably the best piece of research I've ever put out in my career, and I'm a pretty damn good research analyst. Getting into our VAMs and probable range distributions, U.S. dollar index, that's bullish VAMs, minus 1.9% of downside versus 1.1% of upside. Gold neutral VAMs, minus 1.4% of downside versus 4.9% of upside. Still breaking down. It looks like it wants to break the bearish VAMs there on gold. 10-year Treasury yield bullish VAMs, minus 4 basis points of downside to the lower boundary of its probable range of 47 basis points of upside. So we're about to get a test on whether or not this is really the moment to buy bonds. If we start to break down through that probable range, the lower boundary, it's going to be a leading indicator that we're about to break down to bearish. Or though if we bounce off of it, it's telling you that the Fed, not the Fed, but the inflation dynamics have really not yet cooled enough vis-a-vis the growth outlook. High yield OAS credit spreads bullish VAM still 52 basis points of downside in its probable range with 26 basis points of upside. S&P 500 bearish VAMs minus 3.8% of downside with 9% of upside. I mean, just crashing. We talked about this in our scouting report as well. We see a 3,200 to 3,400 range in terms of the fair value for the Fed put. It may come sooner depending on what happens with inflation. Again, we outlined the scenario analysis associated with that. I think it's slide 109, and specifically in that report on slide on VIX neutral VAMs. Looks like vol products have been underperforming because hedge funds have taken their ball and gone home. Passive investors certainly have not, and I think they're going to wind up taking their ball and going home if we start to see more pain. 36% of downside versus 19% of upside in its probable range. NASDAQ 100 bearish VAMs crashing minus 4.3% of downside versus 12.7% of upside. Russell 2000 bearish VAMs crashing minus 3% of downside versus 12.3% of upside. Bitcoin bearish VAMs crashing at the lower boundary of its probable range with 32% upside. Don't bet on that 32% from here. Ethereum bearish VAMs crashing at the lower boundary of its probable range with 44% of upside. Don't bet on that immediately from here. Shanghai Composite bearish VAMs only 0.9% of upside with 8.9% of downside. WTI crude oil neutral VAMs kind of hanging out here. Still fair fight, minus 10% of downside versus 10% of upside. Agricultural neutral VAMs minus 2.4% of downside versus 3.9% of upside. And then industrial metals, neutral VAMs on its way to being bearish. I bet it's probably bearish by the end of the week or next week, early part of next week. It's obviously well below, it's exhausted below the lower boundary of its probable range of 14% of upside. Will we get that upside? Highly unlikely, just given where we are in the growth cycle. Still have a lot of slowing to go. Still have a lot of guidance that needs to get taken down, both from a GDP perspective, but more importantly, from an earnings and cash flow perspective out of companies. So just be patient. Don't freak out. Have a plan and make good choices. Catch you back here tomorrow. Cheers.